Next, we discuss the liquidity ratios in detail. The term liquidity is described as a convertibility of asset ultimately into cash. In the course of normal business, the operations and the maintenance of regular cash flow. The liquidity ratio measures the ability of the firm to meet its short-term obligation and reflect the short-term financial strength and solvency of the firm. And it involves the current ratio. How we calculate the current ratio? Current assets divided by current liability, we calculate the current ratio. The ratio of the firm's current assets to current liability are called the current ratio. Current assets include the cash and bank balance, marketable security, inventories of raw material, semi-finished and work in progress, and finished goods, debtors, and net provisions for the bad and doubtful debts, bills receivable and prepaid expenses are included in the current asset. And what are the things are come under the current liability? It involves the trade creditors, bills payable, bank credit, provision for taxations and dividend payable, outstanding expense that are be used for the current liability for the current ratio calculation. And generally 2:1 is considered as the ideal for a concern. The current asset should be twice of the current liability. If the current asset are 2 times of the current liability, there will be no adverse effect on the business operation when the payment of current liability are made. If ratio is less than 2, its difficulty may be experienced in the payment of current liability and day-to-day operation of the business may suffer. If the ratio is higher than 2, it's very comfortable for the creditor, but for the concern, it indicates idle fund and lack of enthusiasm for work. Next, the liquid and quick ratio. The term quick asset refers to the current assets which can be converted into cash immediately or at short notice. Thus, quick asset consists cash, marketable securities and accounts receivable. Inventories and prepaid expense are excluded from the quick asset because they are slowly converted into cash. How we calculate the liquid or quick ratio? Liquid ratio is calculated by quick assets divided by current liabilities. And 1:1 ratio is considered as the ideal ratio of liquid ratio. Firm because it was to keep the liquid asset at least equal to the current liability at all times. Next one is the absolute liquid ratio or cash ratio. Absolute liquid ratio is calculated by dividing the absolute liquid assets by current liability. The absolute liquid assets include cash in hand, cash at bank and marketable securities are also included in the absolute liquid ratio. And the absolute liquid ratio is equal to absolute quick asset divided by current liability. The acceptable norm of this ratio is 50% or 0.51 or 1.2 is the standard ratio.